Let's get started. See how the market's been treating us this week. Things are pretty good. Risk disclaimer: we understand risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose, whether trading stocks, options, futures, forex, cryptos, whatever investment vehicles you're trading. You know the deal. If you're following me out there on social media, I've seen some new ones pop up. They're actually scammers using my scammer callouts to try to get more people. I'm telling you, if you're following me, make sure it's the real me. YouTube.com/Chris Pulver Mondays and Fridays for my weekly outlook and recaps. Social handles: real Chris Pulver. No numbers, no underscores, no misspellings. I never reach out directly. You can contact me, I'll reply, but never me first direct messaging you, just so you know. All right, that's the deal. Let's get to it. Happy trading, everybody. Let's go to this and this. There we go. All right, let me see who's in the house today. Say hi, say hello, say happy Friday. So this is the currency strength chart you're looking at right now. The JPY is creeping up to the highs. We had an ECB rate hike yesterday, but a big announcement on the TPI, which is their new bond purchase program to help countries like Italy and others that are in some trouble. Inflation still remains pretty high in the Eurozone, as it does with a lot of parts of the world, but interest rates are being raised, and the ECB is on the path right now to get towards 1.5% potentially by the end of the year. And then the TPI program is something that can possibly help some of the countries that would struggle from the rates increasing. But that was yesterday, and this was yesterday's currency strength move. Euro had a big boost in the morning during that ECB press conference, or the ECB rate decision, and then the press conference and everything kind of put it back down to where it started. And today, it is one of the weaker currencies. Now we'll see if this comes fighting back. We have the Fed next week, Wednesday, for the rate decision, which is expected to be 0.75%, potentially 1%. We'll see what the markets are going to do based on the Fed. We'll see what the equities market's going to do. I have a couple of interesting correlations I want to talk about today. But first, let's say hi to everybody. What's up, Joe? How are you, sir? Donna, good morning. Linda, good morning. David, Sterling, Dennis, Peter. Nimmer, what's up, dude? How are you, man? Scott's in the house. Cryo. What's up, Cryodex? Greg's here. Mike's here. Don, Angelina, good morning. Wayne Everett, good morning. Jason, Daniel, good morning. Steve, good morning. All right, nice to see everybody. Cool. Yep, if you do me a favor, hit that thumbs up button for me. Just get it out of the way. Take 1 second, like it, and as everyone comes in to watch the channel, let's see if we can saturate that thumbs button to the upside. Cool. It's all about recession now. Well, actually, I think it's all about the Fed, to be honest. So let me actually show a couple of charts that I think are really interesting, some correlations that I've been looking at for this week. This chart right here, if you can see this is CPI year over year compared to the S&P 500. Okay, so I thought this was interesting. Reason why? There's a couple of references that I want to pull from. I've got, let's see, where is my, I think it's right here. Nope. Is it over here? Aha, so we're going to reference this. We're going to have a little discussion on this. This is a span of, this is 1962, 1970. This is the halfway point. So the first half of the year, how the year finished in both 1962 and 1970. The chart that I have right here, if you can see this, let me bring up my drawing tool. So this is CPI year over year in blue compared to the S&P 500. Now I'm taking this chart back into the 70s because between 1960, what was this, 1962 and 1970, and the 70s and the early 80s and even the 90s, there are correlations that I'm trying to pull from what has the market done in situations like this. Mark Twain always says, history doesn't repeat itself, but it often rhymes. This is one of those situations where I'm seeing some similarities of events that the market has navigated before. And, you know, again, maybe it's different this time. Maybe because it's inflation plus an election cycle plus a recession plus tightening. Maybe it's all different. There's a Wall Street Journal video that I caught this week that I shared with some traders in my trading rooms. Look, they've said that for the history of recessions, we've had 12, I believe, in the last 60 or 70 years. They're different. They're all different. They're all nuanced, and there's just subtleties in each one. But a recession is a recession, and it's not just as simple as two contracting quarters. There's other stuff to go with it. So anyway, what I want to show you is right here. Take a look at this peak in CPI, peak in inflation, and a bottom in equities. Okay, the peak in CPI and the swift decline of CPI right here, and close to it you can see that we have a bottom in equity. So this one lines up a little bit different, but this is in the 70s. So this one almost lines up perfectly. The peak in CPI lines up almost beautifully with this bottom in equities. This one was a little bit leading, right? So we had the peak in CPI, but CPI coming down, and then shortly after that, we found a bottom in equities and then started to rally. Okay, so if we're in the situation where inflation is getting under control, one thing that's been interesting to know is gas at the pump prices started to go down. All right, as that has been going down, the Nasdaq has been going up, the S&P has been going up, equities have found some footing. This has actually been a pretty green week. Now, I'm not saying that the bears are out of control. I'm not saying the bears are letting the bulls take over all of a sudden, shifting the overall trend. We still have the Fed next week. We're not done with summer trading. We might still have an ugly August, September. We might be facing another round of poor earnings. This could be an earnings compression that kind of possibly puts that full capitulation move in the equities market. We don't know. All right. What I do know is that my timeline for trading, my timeline for getting more aggressive and more bullish turns to the charts that I was showing earlier in 1962 and 1970. So first off, can everybody see this pretty clearly? Right? If I draw on it and line this up, peak in CPI to the bottom in equities, peak in CPI, a little bit of lag, but the equities found low slightly shortly after that, and we found a nice little rally point on both of those. Right? Now let's go into this. I'm going to zoom in if it'll let me. It won't. Let's see if I can make this. This is about as large as I can make this. So as long as you can see it, I'll draw on it, okay? This was the first half of 1962, right here. So the first half of trading in the S&P was down. What preceded after this kind of June, July bottom was a summer rally. So we had, coming out of June and July bottoms, we rallied into August, September. Now, September effect is usually one. So June and September are two of the worst months in history for the stock market. They still have green records as far as 1928 to present. They still have green returns, but they're not as bullish. In fact, they're way lower than other months. But anyway, so we have this post summer rally that gets us out into August, September, and then September into October decline into a midterm election. Okay. But what's interesting here is that decline did not find fresh lows. We came back down to test the low, but didn't, and then the market found a way to rally to the end of the year. We had a Q4 rally in 1962 that went from 20+% to the downside to finish the year around 11% to the downside. So we went, I'll type this out. So we went from, this is again 1962. So 1962, the market was, we'll go 1H, which is the first half of the year, was negative 20+%. Okay, and then the second half of the year finished negative 0.118. So my question to you is, did the market fight back? Yes, it did. Okay, now let's go into 1970. 1970, what did the market do? The market started off from this high point all the way down. That's a little bit bigger than I want, so let me do this again. Right here. Market goes down into a low point in May and June. We have a low. In July, we have a higher low. In August, September, we have higher lows. And out of summer, again, midterm election year, the market continued to rally, make higher highs and higher lows, and get up to break even. 0.1% positive on the year. So again, I asked the question, does the market have the ability to fight back? This is 1970. First half of the year was down 20+%. Okay, and then the second half of the year finished positive 0.1%. It goes from a full negative to a full positive. That's happened 35% of the time since 1928. Okay, now I'm not saying that's a high probability, but at least it does it. But what does happen is once we find our low point for the year, the market tends to respond and rally off of it. Okay, so what does 2022 hold for us? I don't know. I don't have a crystal ball, neither do you. But I'm trying to draw some parallels to figure out, okay, this is where we are at the halfway point. So going forward, are we going to see something in the S&P that does this? Are we going to have a earnings compression where things come back down to retest? Maybe we retest those June lows. Okay, maybe we have a slightly higher low and the market fights back, and we end up finishing the year maybe half. Right, we had a 23-24% downside move, for the peak to trough in the S&P. If that's as low as it gets, maybe the market finishes at minus 12%, minus 10% for the year. It's still a fight back. it's still a reason for me to be positioned bullish to finish out the rest of the year. I know we still have the Fed to worry about. Okay, I know we still have tightening to worry about. But the one thing the markets have been doing is they have been pricing in the Fed. Okay, so if the Fed delivers a rate decision next week and it's 0.75%, they're really not going to exceed what the market's already priced in. The market's priced in 3.5% to be the official Fed's rate by the end of the year. If the Fed is getting to that point, the market's already priced it in. If the Fed is going to not be at that point, below it, I think the market can rip a little bit higher with a little bit more, kind of slack and freedom and runway before the tightening continues. If the Fed is going to exceed that, then that's going to be a problem because the market's going to have to reposition, and it's been this moving target for the last 6 months. Okay, so 1962, 1970, a couple times in the 70s with CPI, 1980s as well with CPI, and here we are putting all that together in some type of blended. Also we have this tech situation from 2000 to 2022 that tech got crushed, and it took 16 years for the Nasdaq 100 composite to get back and break those highs. But after we had this huge decline, we took 6, 7, 8, 9 years to build and accumulate, and then the rally became one of the best performing instruments in the last 20 years by far. Like the Nasdaq 100 was 900+% gains over the last 20 years. That's a 45% compounded annualized return. Crazy. Well, compounded if you keep your money in the investments. Okay. So, question to you: does it make sense? I hope it does. It's been some deep digging to find stuff like this, but this is what we're trying to do. We're trying to make some sense of, like I said, doesn't mean it's going to repeat itself. But if there's some similarities to pull from, this is a midterm election year with a terrible first half of trading. We had that this year, right? We have a midterm election coming this year in the U.S. We have a terrible first half of trading. Okay, you've got earnings, you've got inflation, you've got tightening cycles from the Fed. All these things have happened at some point in the last 50 to 70 years. So does the market find a way to fight through this stuff? Yes. Reason why is because it's a forward-thinking mechanism. So whenever the market has this sign to say, look, we've priced in all the bad, it's time to start repositioning for something better, and the market's thinking 6 to 8 months out. And if that involves the Fed, if that involves inflation numbers coming down, if that involves, getting through this energy crunch and crisis with Russia, Ukraine, okay, give the market something good, but we will see. So I've said this in my trading rooms. I'm fairly optimistic for the second half of the year. I don't know if it's going to be a rough next couple of months. Maybe we have a rough July to finish out the month. Maybe we have a rough August. Let's get into the charts and we'll take a look at it. Okay, so if I go into the charts right here, so far we've had a pretty solid week. In fact, we're just shy of 4,000. I've been looking at levels. Let's see here. Let me log into something really quickly. And I'm going to use my S&P chart. So I projected a couple of resistance levels. It should be right around 4,000. That was my projection on the S&P, which is right around, it's 2.5 points higher, and also on the Qs, which I believe the Qs should have been also looking to go up towards a round number like 310, possibly a little bit higher. But I'll show you that in a second. Just give me one moment here. All right, so let me check this. Yes, okay. I'll get logged in. All right. Yeah, as long as the market moves, exactly. I mean, yes, we need volatility. We're probably going to get it. So let me float this out for a moment. And can everybody see this? Oh, fudge, don't do that. That's not what I wanted. Nuts. All right, well, let me do that again. Okay, so let's take a look at the SPY. Move this over here, and I was projecting a couple of spots right there. So are we in this first target? Yes or no? Okay, so as we had a close above this high, being bullish on the S&P, it's not a surprise. Now, I could see a little bit of a pullback coming here, but if we're taking out this high and this high, coming back into this gap, we have some pocket levels all the way back into the zone. So between 400 and 405 in the SPY, I think that's where price is able to go, at least in this near-term rally. So there could be a little bit left in the tank today. There could be a little bit left early next week, pre-Fed. And make sure that if you are long, and this is the case for me in equities on demand, if we are long equities, we could expect a bit of a pullback coming by Wednesday, Thursday, Friday if the Fed kind of throws water on this little fire move. Okay, so that is the SPY. Take a look at the QQQ. Same thing here. Oops, get rid of that. Try that again. And same thing. We just took out these recent highs. So projecting a high right there, projecting a high right there. Are we in that zone? Do we come back and fill this gap, find this pocket? Yes and yes. So I could see a little bit of the run in tech finding some resistance. Okay. If it stays bullish today, great. But I think this would be an awesome week to get some stocks called away for profit, to take some profit, protect some profit just in case. I will also project, just in case this thing wants to go a little bit higher, I will project this as well. If we take out that high, there is a lot of room to run on a bigger recovery for tech. Now, that might be a tall order right now because I still think longer term, the bear market is still in control, right? So this is still a bear market and a downward channel. If we came up into this, 320, 325 level on the Qs, I think we're going to run into some pretty fierce resistance. Part of me thinks it's going to be more resistant now since we've already hit some of these near-term targets. So if this is a correction this way, I think we're going to run into some resistance now and probably start seeing some profit taking this week. But it's good enough to get some stocks called away. I hopefully will have MicroStrategies called away for profit today if it's above 290. Carvana I'm getting called away for a couple bucks a share. Facebook I'm getting called away for like $11 or $12 a share. So I mean there's been some good trades to take advantage of this volatility. Tech has led the way. Tech has outperformed the S&P this week. Okay, so overall pretty good stuff. And let me organize this again. And let's have a look. So I have some expirations I need to review today. But it's been a fairly reasonable week to manage some profit. Forex wise, we'll take a look at some Forex pairs. I've been watching the dollar index. The JPY is strong this morning. So let's go to dollar index. The Fed next week. I've been talking about this correction coming technically for several weeks now. I didn't want to call the top on the dollar, but I said within reason, we have these really high bar counts. We have these extremes. I'm expecting the dollar to do something like this. If this is a rising wedge, we fall back into this 50 EMA. I think if we break below this EMA, we expect this to drop down into the 200. So here's where this started. Here's past resistance, and here's our moving 200 EMA. So it could correct very similar to what oil did over the last month. Oil, I can go to crude oil futures right here, and I can go to US oil. Pay attention to this line right here. We had our 50 period EMA. As soon as price broke it, we break, we retest, and we go. And we found that 200 EMA. So there are tech stocks that look the same way. There are dollar indices, the dollar index, the DXY, the euro dollar look the same way. The dollar yen looks the same way. We just need to find a move to and slightly below this 50 EMA. So if I go back to that dollar index, can we make a move down to this 50 EMA? I think we can. I think we will. I think the Fed will help. If it doesn't, let's say the Fed pops it back up here. I'm still looking for resistance. I'm still looking for this to cooperate. Find the 50, break through it, drop lower. Once that correction is in, I'm going to see how much profit I can pull on some of these dollar crosses. That might be it. We might be in a correction phase in the dollar. But I've said this, and I was really firm on this week with traders in my rooms. I think if the markets are going to rally to the upside, if we're going to have a Bitcoin rally, a crypto rally, Ethereum rally, and we're going to have a risk appetite rally in equities, if we're going up for the second half of the year, I think the dollar has to go down. Okay, that was one more chart that I pulled. Let me see if I have it in here handy. Let me check here. This is from that Wall Street Journal article I was talking about. There it is. So this is the dollar versus Bitcoin versus the S&P all overlaid. So the summary of this chart is when the dollar goes down, risk assets go up. So it's been very consistent for the last 10, 12 years. If we see the dollar dropping, we have equities rallying and Bitcoin rallying. And I think if you fast forward into today, the dollar has been much, much stronger. Equities has dipped. Bitcoin has dipped. So if we're going to see Bitcoin and equities rally for the second half of the year, the dollar should be taking a break and breather and correct. If the dollar continues to run, that's going to be trouble ahead for equities and for Bitcoin. But I think, like I said, the market is forward thinking. I think the market is kind of pricing in, worst case scenarios. If things get a little bit better from the inflation side, if things get a little bit better from gas at the pump prices, then we're looking for a reason for equities to jump for joy and start to rally. Okay. All right. Oil. Yeah, I mean, oil, look, we've had trends on oil, okay? We've had severe trends, right? We went from, $70, $80 down to 0, all the way back up to 100 plus. We topped out here at 129, okay? Now, I have these dotted lines that might represent a little bit of a corrective channel. I still think right now that, and look, I mean, for this full-blown energy crisis we're going through and this, Eastern Europe conflict with Russia, Ukraine, and it's not getting any better right now, the fact that oil prices have been somewhat contained and materials, commodities, and oil prices have dropped, that's a good thing. Okay, pay at the pump prices have dropped. That's a good thing. One thing that happens in these markets is we have these long trend cycles, and then at some point we're going to find consolidation. And I think that oil might be a perfect candidate for that. We had this big trend to the downside when we crashed during COVID. We had this big trend to the upside that just kept going relentlessly. I could see oil operating at higher levels, higher highs, but still finding some supply and demand levels between, let's say, 100, or I'm sorry, 130 highs or 120 highs down to maybe 90 lows. So I could see a bigger range developing on oil, whether it's sideways, like perfectly horizontal, or slightly angled. I'm expecting more of a channel behavior on oil for right now. So, my outlook on this is if we come down to support, pretty interested in going long energy, long oil. Come back up to resistance, pretty interested in going short. Trade the range. I think that's what we're going to deal with here for the next maybe 3 to 6 months. And if we can range here, that means we can kind of contain this potential energy crisis before it gets worse. I mean, Europe is making some big strides right now to push towards green. They're pushing way more for nuclear alternatives right now, and trying to get some of that dependency off of Russian oil, right? But that's my outlook there. Let's go to a couple other instruments. SVXY just follows the S&P pretty closely. So SVXY. Am I going to get it called away this week? $54 covered call. Did I? Oh yeah, that expired last week at $51.50 or $52, and so I just put it out here to 54. Was it 54? I'll have to double check that. Let me check my notes. SVXY, is it in here somewhere? I'm looking for it. 729, 51.50 covered call. So that was not called away. I'm gonna have to double check and see what I put on. I have a break even around like $48 or $50 depending on my account, and we had a nice little rally. I'm gonna try to lose this at 54 bucks or something. If I get it called away, 51.50 is pre-market. I'll just keep an eye on it. But this is one that's been good to repair. Like I said, I should be losing some stock in Meta this week. So I did a 170 call. What I might end up doing, so pre-market's 173. Snapchat had a terrible earnings report, or at least price treated it bad, which isn't a terrible thing. So we did take money on this credit spread out to, this was last Friday's expiration. Now that we're down to 11 bucks, I want to see if we have any Snapchat going out further. I'll probably end up taking some profit on that long put and taking some assignment at a slightly lower price and just sit on Snapchat for a little bit longer. Yes, we have them right here. So we have the October and the January credit spreads, the 15 by 14, the 15 by 14. So on one of these, I don't mind taking assignment, $11.09. I mean, how low does Snapchat go? Their users keep growing. I mean, the user base on Snapchat continues to go higher. All right. So what's interesting is, yes, earnings kind of I'm not saying overreacted, but obviously it's to the downside, and that's a huge reversal. So being up here for the week at $16 and reversing down, that's a 35% drop from yesterday's close to today's pre-market open. That is just crushing. But at the same time, if we have an open here, we have this massive gap, and we have this gap right here, guess what? If I can take some ownership at these lows and this market just stabilizes with some divergence, I think Snapchat can range back up to $15, $16. We can make some money. I think it can come back and fill this gap eventually with a broader market recovery, get back to $20. So if I own some Snapchat around $11, $12 a share and I let it go at 18 to 20 bucks a share, I'm happy doing that. I think that's a pretty great return. So I am watching Snapchat for that. On Meta, I actually bought it low enough where I'm going to let it go around 170. So if we stay where we are, I'll still lose Meta for about 12 bucks a share. One stock for today is MSTR. That's MicroStrategy. We're trading at 298. I have a covered call at 290. I could lose this for about 12.50 a share, which I'm pretty happy to do that. I've got some more shares that I'm still going to let run. I've got some credit spreads I'm going to let run. So trying to hang on to MicroStrategy a little bit longer. Carvana this week, I'm going to let it go as well. We're at 20, man, 28. What a crazy run. I'm going to get it called away at 22.50. Now, I could look at it today and try to roll it, but like I said, with the Fed coming up next week, I don't really want to go out any further. Plus, I did a bigger position than probably what I should have. So I'm just going to let it go, take the money. I'm going to take about $1.15 a share, but I've got a couple thousand shares locked in. So overall, for literally 3 days of trading, I'm going to make a couple $1,000s. I'm pretty happy with that. Right? Let's go to Forex really quickly. So let's talk DXY. So same thing with the dollar index. If we drop down into this 50 period, drop down into these levels here, this 200 EMA, this is a pretty high bar count on a daily time frame. Okay, this goes back into, I think, September of 2021. We now have 228 bars. Now the dollar yen is like 360 bars. It's way further overextended as far as the timetable goes. It's way further overextended from a distance for the EMAs that I'm talking about. But on a daily time frame, 200 plus bars is a lot. All right, and you take that with the technicals of this looks like a pretty solid rising wedge candidate if we break this structure. If we break down and find this 50 EMA and we consolidate here, I think we can head down and have a 1, 2, 3 wave move and find this 200 EMA, find this low where this rising wedge started. So I am technically very interested in a dollar correction. If it's not going to start next week with the Fed on Wednesday, I expect this to transition during the month of August. Usually August can be a very tricky month. It can be a low volume month. We've seen flash crashes in August, but I'm just saying from a seasonality standpoint, it's kind of a breaking point. We've had all these trends from January to August. We've had trends in the dollar, we've had trends in the yen, we've had trends in the CAD, we've had trends in the euro. Very trend friendly environment. Okay, trends don't last forever. And as a Forex trader, most traders know that. Most traders know that, 70+% of the time, it seems like there are no trends unless you're trading intraday and trying to get some ranges. But for even higher time frames, there's not a lot of massive trends. But we have had a very trend friendly environment. So it's been great to be a trend trader. It's been difficult to be a range trader because we've had such aggressive breakouts and stubborn moves. But with those extremes, there's a reversion to the mean. With those extremes, the technicals and the efficiency start to obey at some point. Okay. All right. So makes sense. That's DXY. Any charts you'd like me to take a look at this morning? Any currencies? So again, we'll take a look at the currency strength chart. We're sitting here with pound and euro on the weak side. The JPY is getting stronger. I do have a couple of stacked orders that are pending. They may be getting filled here on the CAD yen. I've got to trade at 106.08 to kick this thing off. I could look for a very quick move down to this 104. CAD yen again, pretty high bar count on the daily. Let's measure this. Last time we were hitting this area was December. We're sitting around 155 bars. Even if we just make a quick run down into this 50 period, that's at least some short-term trading. I have a 106.08, a 105.90, a 105.70. If I was able to get some profit down here to 104, I'd actually be pretty happy protecting. But I did tell traders this week that if it drops lower, I want to stay on this thing for some tier out levels. Alcoa is above 46.50. That's a big thumbs up for me because I'm going to lose that stock this week as well. PHM 46.01. That's good too. All right. Well, hopefully these alerts are going to stay there, not just poke up and then drop back down. I hate it when we fill higher and then we gap low, or we gap higher than we fill those gaps. So if the CAD yen can drop down to the 50, I may take, this is kind of target 1, target 2, target 3 for my sell trades. So target 1, target 2, target 3. I'm taking 3 separate orders. They're all different trade sizes. I can scale out of them with different stops and different take profits. So I'm going to try to ride this CAD yen a little bit, but 104 is not a bad spot. It's still another 200 pips lower, and I think it's doable. There you go. Short dollar yen up 200 pips. You were up like 50 pips earlier, right? Got 42 pips on one, 202 pips on another. Really want to hold. Yep. Monthly pivot's a good spot. Let's go to dollar yen. Dollar yen's fantastic. Look at that. That 50 EMA all the way down to that monthly. That looks great. That does look really good. Yep. So, we're starting to get at least a turn on the dollar index. We're starting to get a turn on the yen. So can we come back to find this pivot? I think so. Can we find this past resistance becoming support? I think so. Can we end up, like I said, gravitating through this area, pausing and dropping lower? If we have an earnings compression, that was actually one more thing. Did I email this to myself? I think I did. I did. Check out this chart right here. One more chart that I can share with you. This is from a Bloomberg terminal. This is Jordy Visser from Weiss Capital Management. Really good stuff on this. This is S&P forward earnings and the S&P live. And what he sees here is this is the S&P 500 that's dropped, as we saw our 20+% decline this year, but also our earnings are sitting here at the highs. So we really haven't budged on earnings. And one thing that could happen is earnings could start to tip to the down. Let me change this to white for a second. If the earnings tips to the downside, okay, then we could see another flush in the S&P, possibly to the downside. But again, I just want you to look at see how these have cooperated and correlated. So we had the S&P earnings dropping with the S&P. We had S&P earnings dropping with the S&P, right? Sometimes it's the S&P that leads. That's what's interesting. Like right here, the S&P was dropping, then earnings started to catch up. S&P was dropping, then earnings caught up. S&P was dropping, earnings can catch up. So I think what's going to be interesting about this is if earnings start to catch up and realign here, does the S&P necessarily go that much lower? Possibly not. We might retest the lows, we might flush down and capitulate back to the lows, but I don't really see the S&P going too much lower. Again, I could be wrong, but this has been in alignment now since this is the 90s. This is back to 1990. So 30 years to show how this is aligned in the last 30 years. Like you see that the S&P with S&P earnings does matter. Okay. All right. So that's bringing a lot of stuff to the table. I know that's a lot to digest, but I think it's important that we talk about all this stuff. All right. So dollar yen, yes, dollar yen's looking great. Looking great. And hopefully, honestly, 134, you're still 250 pips away. I think it'd be an excellent, excellent trade to hold this till you hit that monthly pivot, to hold this till you find that 50 EMA in the daily time frame, and then be prepared. I'm trying to be prepared here. I'm trying to be prepared for this to find this pivot, pause a little bit, or have a retest, and then drop again. So a 1, 2, 3 wave move, dollar index, dollar yen, bar counts, tops, transitions, highs and lows, extreme conditions starting to find reversions. This could all line up in all these technicals we've been, man, I think this chart's broken. They can all start to realign. So that is a good thing. Okay. A couple chart alarms went off on my end. Alcoa is another stock that I might end up getting called away this week. I have a covered call at $46, and hopefully it stays there. I've got a break even at 44.05, so I lose it for $1.95 on the shares that I have. That would be good. I'll be watching that one today. Halliburton, oops, wrong one. Halliburton's another one. I'm trying to get it called away at $30. It's trading at 28.55. I'll just keep preparing this one. And yeah, I mean, there's a list to watch to see if I get stocks called away prior to the Fed next week on Wednesday. All eyes are going to be on the Fed next week. Here is the July expectation. Let me refresh this. So this is the July expectation, 77.5% probability that the Fed will raise 75 basis points. Now, if you remember, last week during CPI News on Wednesday, this was all over the place. This is what it looked like on Tuesday last week. And then on Wednesday, it completely flipped, and it was about 80-20 the other favor. The other way was, 1% is going to be expected. Okay, and then after that, they saw look, the market kind of digested the difference between core inflation and headline inflation. Core inflation is still going down for the last 3 months. Headline inflation is starting to show better signs. Gas at the pump prices are dropping. So headline inflation, although it printed higher, all right, and it printed higher in Canada, printed higher in the UK. Look, headline inflation because of energy and food is printing higher, but core inflation is printing lower. So we're back to this discussion with the Fed. They're raising rates by 75 basis points, and they'll probably do a 75 for July and a 75 for September, and then November, December will be fairly quiet. I think at that point, it gives the Fed enough time to really assess how well inflation is coming back. If inflation is dropping, okay, it doesn't have to be, look, we don't have to be at 2% inflation. If inflation is trending lower, I think that's a good sign for the Fed to slowly look at rate hikes and tightening through the next, Q4, Q1, Q2 of next year. And that's where the market has its second half recovery, right? But if inflation is sticky and all of a sudden we see like a big jump in energy again, big jump in food prices again, headline inflation is going to continue to stay high, and it's all about that core inflation, right? We've seen a big drop in real estate this week, right? It was real estate, XLRE. You also had housing starts, applications, permits were at lows, back to like 2008 levels, 2001 levels. You've got Bank of America fund manager surveys that were showing all-time pessimism and tons of cash, like sitting on the sidelines with very low allocation levels. So there is money to go to work. It's just trying to decide when. Okay. New Zealand Cad. Yep, let's take a look at that one, and then I'll start wrapping things up. Get ready for class at the top of the hour. New Zealand Cad. So I'm long in New Zealand Cad, trying to stay long. We have a nice monthly pivot around 8,100, and I'm trying to get back just to a simple high. I think this is a really solid falling wedge pattern. Okay, and so I'm looking to see it. Again, it's a slow mover, but if we come back up to that pivot, excellent. If we start to break above this falling wedge structure, then we should come all the way back up to where we started, which puts us back to past support, become a resistance right around 8,300 to 8,330. Yep, so your break even's 82.88. I mean, you could possibly, add a small position here, or if we get a retest of these lows, add a small position here, work that cost average down. But my target is, 83 to 83.50. I think that if you're able to, if you can work the cost basis down a little bit, I still like this high right here just to be safe, around 82.50. So I am currently long. My break even's around 81 on the New Zealand CAD. So I'm trying to get to 82 or 83, and I'll take some profit. Yep, but it looks good. I'm long in Aussie CAD, New Zealand CAD. Yep, I'm long in those. Okie dokie. All right, everybody. I'll let you go. If you would do me a favor, for everyone watching, hit that thumbs up button for me. Support the channel. YouTube appreciates it. I appreciate it. And let's get that saturation for the algorithm. And I'll be back on Monday. Mondays and Fridays, youtube.com/Chris Pulver. Thanks for watching. Thanks for being here. And happy trading, lots of profits. Thanks, everybody. Equities on Man students, to see you at the top of the hour at 10 o'clock. We'll kick off a little end of week and see how we can get everything locked up. Cool. Nice to see everybody. Take care. Bye. Have a great weekend.